Welcome to our video on risk management. In this video, we will be covering most of the effective ways to manage risk in your trading, including position sizing, stop loss placement, and more. By the end of this video, you will have a solid understanding of how to protect your capital and maximize your returns. So what is risk? Risk is an inherent and inevitable aspect of trading, representing the potential for financial loss or harm when executing a trade. It manifests in various forms. 1. Market risk. It is the possibility of losses due to unfavorable movement, liquidity, or volatility. In other words, not your fault, just the market did its own thing. Next, we have leverage risk. These are amplified losses when using borrowed capital or margin. We'll speak more about leverage shortly. Then we have operational risk. These are losses from failed process, failed system, from FOMO, or just a personal error that you make on your own. Listen, understanding and managing these forms of risk is crucial to making you become a successful trader, one who is profitable over time. Understanding and making these diverse forms of risk is crucial for traders to minimize losses and increase their chances for good success. So let's dive into one important part of managing risk, which is risk to reward ratio. Understanding your risk to reward ratio is crucial to making informed decisions. The risk to reward ratio is a fundamental concept in trading and investing that measures the potential return on investment, your ROI, against potential loss. The risk to reward ratio helps traders or investors to evaluate the potential profitability of a trade or investment. It helps to set stop loss and profit levels. It helps to determine position size. It helps to compare different investment opportunities. Now, how is it calculated? Risk to reward is expressed in a ratio typically represented as 1 by x. So 1 being the risk and x being the reward. A risk to reward ratio of 1 to 1 means that for every dollar risk, the potential profit is $1. A risk to reward of 1 to 2 means that for every dollar risked, the potential returns is $2. A risk to reward ratio of 1 to 3 means that for every dollar risked, $3 is expected as potential profit. In application of risk to reward, it's good to aim for a higher risk to reward ratio because it potentially gives you an ability to have more profits than losses. However, it has to be guided with data. You should not have a high risk to reward just because you want to, but the technical analysis has to show you that it is possible for you to get that reward. Now, how does risk to reward help risk management? Because if you look at a trade, you're about to enter a trade, your risk is 30 pips, and then your reward seems to be 25 pips. That is a bad trade. It's not worth entering. If your risk is 30 pips and your reward is 30 pips, then you can be like, oh, okay, cool, this is fair, this is a balance, this is a 50-50. But then when you have 30 pips as your risk, 60 pips as your profit, and so on, that is getting better and better. So apply it nicely. So looking at it, you can see how this helps you manage your risk. Next, we have position sizing. This is a process that determines how much of your capital to allocate to a single trade. There are fixed fractional ways of applying position size, and there is volatility based approaches. So first, fixed fractional. This means things are fixed. Your lot size is fixed. You allocate a fixed fraction of your account to a trade. For instance, you allocate 2% of your account to every trade. That is fixed. You set a take profit and a stop loss in a certain area, which is 1 to 1 or 1 to 2. That is fixed. Then the second way is volatility. In this method, you adjust your position size according to the market volatility. So if you are someone that would reach 2% on normal circumstances, when you are risking volatility base, you probably reduce it. If you are someone that would only put 20 pips as your stop loss on a normal day, because there's high volatility and because you have reduced your position size, you can increase your stop loss to 30 pips to just to be able to manage it right. You put thoughts into your position sizing. Again, we are all about managing risk. Your position size poses a risk, so you have to think it through and think about factors to help you open your position, not just opening a position. Next, we have stop loss placement methods. Stop loss placement methods are strategies used to determine where to set a stop loss order, which automatically closes as a trade reaches a certain price. Here's a breakdown of some methods. One is static method. In this level, in a buy trade, you have your stop loss below the support, and in a sell trade, you have your stop loss above the resistance. Another fixed method or another static method could be you have a certain pips that you don't exceed for your stop loss. You could say you only risk 20 pips per trade, and that is what it will be. That is a fixed way. So you use that way to determine. Therefore, if the price is too far, if the pips for the stop loss is too high, then you realize that, okay, no, this is a risk I am not willing to risk. Again, risk management. Next, we have trailing stops. Trailing stops is a way to manage money and control risk by moving your stop loss as the trade moves in your favor. So you're already in a trade where you risk 30 pips and now the trade is 50 pips in your favor, it's 30 pips in your favor, you can decide to move your loss from 30 pips to zero, which now becomes a risk-free trade. You have trailed your stop to reduce your risk. Then maybe the trade gets to 60 pips in your favor. You move the stop loss to plus 20 pips. So you've added 20 pips to the price just to be able to also save some of the money that you've already made and continue like that until it gets to your take profit or the market reverses and it takes you out. This method helps traders to maximize profit, minimize loss, and be able to, in the long term, grow their capital. Next, we have leverage management. Leverage is a powerful tool in trading. Leverage is the ratio of the trading size to the margin required, allowing you to control a large position with a small amount of capital. However, it is a big time two-edged sword because leverage, just as leverage has the ability to give you increased profit, it also has the potential to give you great losses. It represents the amount of borrowed capital used to finance a trade. So we have several leverage ratios, and popular ones are 1 times 30, which is 30 times leverage, 100 times leverage, 200 times leverage, 500 times leverage, and so on. Now, calculating leverage. If you have a trade size of $10,000 and the margin required is $100, your leverage would be 100 to 1, meaning that you can control $10,000 with just a $100 margin. So as the leverage reduces, it reduces, and as it increases, it increases. Which leads me to the next point, which is responsible use. A responsible way to use leverage in trading is to not over leverage. Over leveraging has the ability to give you huge profits, yes, but it has the ability to give you great loss, which means it can wipe your account very, very quickly. Now we move to psychology of risk management. Risk management is not only about numbers. Risk management is also about psychology. Like, a big part of risk management is about psychology. And the following are the breakdowns of the things in our psychology that affects our risk. One is fear. Fear of loss. Avoiding trades out of fear, wanting to be perfect with analyzing, or closing positions too early due to fear of losing potential losses is one thing that fear can do to your psychology. This fear will put you in a position where you wouldn't get the most out of your profitable trade, but you will get the most out of your loss. I'll explain. Because you are afraid to lose profits that are already made, you will close your trades prematurely. So a trader is meant to give you $100. Now you've seen price push up to $30, and now it goes down to 15, then it goes to 29, going down to 24. You want to close it quickly because you don't want to lose that money. But when it's on the other side and it's going down against you, because you want to make your money back, you'll just be there and you'll watch it hit your stop loss. So now, if your trades are always hitting your stop loss but not getting reasonable profits, in the long term, even if you are profitable, even if your trade goes right 60% of the time, in the long term you will end up not being profitable. So this affects a lot of people, because some people are already good in their trading right now, but because of improper risk management, they are not seeing any results. Under fear, we also have FOMO. FOMO is the act of entering trades impulsively due to fear of missing out. So you see a big candle printing out. As it's printing towards a certain direction, you feel like this trade, you are missing out of this trade, then you jump in. But when you jump into that trade, your risk is not calculated, because the trade has probably gone far from your trade. And then when it reverses, it brings a potential bigger loss. So that is not good for your risk management. Next, we have greed. You could have a day and start with a good day and you've made $100. And when you made $100, that $100 adds to your account, and maybe you had 890 in your account, and then there's $100 added to it. Now you have 990, and you're like, maybe I should take $10 more, so I'll round up to $1,000. And the moment you try to take that $10, that is the time your trade goes wrong. You start fighting to make that things go south. This is what greed can do. You've already made money, time to call it a day, but your greed makes you want to make more. This greed now leads you to overconfidence. It leads you to taking excessive trade. It leads you to overtrading. It leads you to also ignore risk. This is bad for your risk management, and this is a psychological thing. Next, we have confirmation bias. Seeking information that supports existing beliefs. So you are already in a trade. The trade is going against you, and you don't want to lose that money. So instead of trying to see exactly what is going on from a neutral point of view, like you are in no trade, you start trying to find things to confirm that, oh no, this trade is still good, this trade is still good, this trade is still good. At the end of it all, it is still fear. It is you not wanting to lose your money. You're just finding ways to assure yourself. Whereas that's a trade that if you had looked at it straight with a clear mind, you would have been able to cut your losses short and probably reverse the trade and end up making money. So confirmation bias is another thing. It's another psychological thing that affects our risk management, because you are just looking for things to support you in that moment, because you don't want to lose your money, or you just want to stay in a particular position. Next, we have the baba of them all, the boss, revenge trading. You're in the market, you've lost money, and you want to make it back. You go in, you remember at first to use your normal risk management, which is 2%. Then you lose 2% of your account from that particular trade. Now you rush it to make it back. And because you've analyzed in your brain that if I make 2% back, I've only made back what I lost, but I've not made more money. So because of that, you increase your risk. You increase your risk, you lose that money, you try again. And in that revenge mode, you are not thinking straight anymore. Things are not clear anymore. What you are seeing is not certain anymore, and then you just start risking more. You probably would make some money and give it back to the market. So revenge trading is another thing that is in our psychology that can affect our risk management. These emotional biases can significantly impact trading decisions and risk management. It's essential to recognize them and address them to maintain a disciplined and objective approach towards trading. Now that we've identified that psychology is part of our risk, let's look into some emotional control techniques that we can have that can help the psychological side of things. One emotional control technique to apply is mindfulness. Practice present moment awareness to reduce stress. Be aware that every day is just another day on the market. There is the next day and the day after and the day after and the day after. Be mindful enough to know that when you lose a trade, there is tomorrow to trade again. You've analyzed, your analysis went wrong. What are the chances that the next one will not go wrong? Be mindful of what you're doing. Be mindful of when you are going against your plan. Be mindful of when you are no longer following the rules, because that is what will always happen. Every trader has been there. I've been there. Be mindful so that the moment you are about to go against the rule, you can call yourself back to order. 2, journaling. Record trades and emotions to identify patterns. Record trades, record all your trades. Why you enter the trade, when you enter the trade. Did you enter a bigger risk? Why did I take this risk? Was it my emotions that made me take this risk? Was I trying to revenge trade? Was I being greedy? Journal, write your trades down, because what to do for you, it will create a person that is watching the person that is trading. That when you go back and look at it, you can recognize errors that you've made, and then you can start working on fixing them. Self-reflection. This is literally everything together. Always go back and check yourself. On Monday, I entered 5 trades. Why did I enter 5 trades? Oh, after the first one, I lost it. Then I lost the second one. And then I just kept on going without information. Self-reflect to know, okay, what was I thinking about in that moment? What was I trying to do? All of these will help you pick up characters and behaviors that don't work. They will help you pick up times where you overtrade. They will help you, it probably get you to a point of realizing when you lose one trade or lose the second trade, probably just go for a walk, go jogging, go play video game, go do whatever, go play with your friends, whatever. That self-reflection will make you realize what is going on, what you are doing to yourself emotionally that is causing you so much risk, and it will help you to work on it. Now let's move over to the chart. Let me just give just a few things I can give as a case study. I will not be able to get all, because all of these things happen in the market. But when we get on the chart, whatever we can find that would work as a case study of the things we've spoken about in regards to risk management, we will touch on them. Now, let's go to the chart. All right, here we are on the chart, TradingView, which is the chart I use as usual. I would cover some of the things we just spoke about in person. Oh, I'm not here in person. On the chart. So let's start with a trade example of like one-to-one risk. So this price is about this. You're expecting candle price to break below this zone, and this is your entry. It's just an instance. You can see right here that it shows us 3-to-1. So it means if this trade goes our direction, we are going to be making 3 times more than the profit than what we would lose if it doesn't go. It doesn't go along with our direction. And I made mention earlier that your risk management, your risk to reward should not just be off your head because, yeah, we've said it's good to have a good risk to reward ratio. No, it has to be something that the market has shown you that it is doable. Like right here, this is support, which means the prediction would have been, okay, my prediction, because this was the trade I entered, my prediction was that if price breaks this point, we are going to touch this support. Now, for me to confirm that that is a good trade, I have to now check my risk to reward to know how much I'll be risking and how much I could be making. Now, I could see that I could be risking a certain amount and making 3 times more as a profit. Now, that is good risk to reward ratio. But if, okay, good example. So it's safe to call this a small support, a small resistance, pardon me. If you are expecting to enter at the breakout, ignore this red, so assume these candles are not here. If the plan was to enter, and you're like, okay, under the previous support, this is the previous support. The previous support would be 31 pips loss. This area right here is also a resistance. And because it's a resistance, look at what you could potentially get if price does not break. So that will tell you that this is too much of a risk to take. The risk is not even worth it. So that can put you in a situation where you will decide to wait to see price break above. And if price breaks above, then you can tell yourself, I have this clean range to go up. So if my stop loss is right here, I have this range to make more. So what I'm trying to emphasize is that it's what I meant when I said that you don't just give yourself a reward because you want to. The data has to make sense. Capish? Capish. And the good thing about 1 to 2 and big larger is that if you get the next trade, you automatically recover the loss you previously had and you make your profit. Another is market volatility. For me to do market volatility, I have to, okay, but we know what happens during market. Let me see if I can find any time of news, any news time right here. let me assume this is news time with this high volatility. So in times like this, it's better for you to go half your normal size that you normally risk, because price is moving crazy. So this way, should price go against you, you are not going to be losing so much. Another position to touch here is FOMO. Let me find a candle that can illustrate how dangerous FOMO can be. Oh yeah, now let's look at this candle right here. When this candle would have been printing, it was going to print and look healthy like this, because remember, it prints all the way, then rejects. So it would have looked as healthy as this one looked, this one right here, and it pushed all the way up and come down. Now you could easily be seeing price just rushing up like that in that momentum, and then you conclude, oh, price is going up, I need to buy, not knowing that price was just pushing to retest these highs and reverse back. So if you are jumped into a trade right here because of FOMO, and go for it. Maybe you jumped in right here because you would have seen it healthy, move all this way. The moment it's breaking above this count, you feel, oh no, buy, and then you assume that it's gonna go all the way up here to FOMO. You enter a trade here, only to have this happen to you. FOMO. Risk management is extremely important if you want to be successful in trading. You need to master risk. In our previous lessons, I spoke about demo account and all of those. So what I need you to do now is to open a demo account. Open a demo account with an amount of money that is an amount that you know you can deposit into your trading at some point. Use that to open an account, and during the week, just try and learn all these skills. Learn to know your risk, learn to know your reward. Start going through all of this. Start every video we share, try to do something practical to make you used to it and learn from it, and then from there we see how it goes. So that is all for today on risk management. Remember that risk management is an ongoing process that requires practice by the day, by refinement. So start by applying these techniques in a demo account. Review it on a regular basis. Review your risk management strategy. Learn, stay updated. Just try and practice everything we've thought about, everything we've spoken about. Just try and practice it, and by incorporating these techniques into your trading strategy, you will be well on your way towards becoming a confident and successful trader. Risk management will help to bring out the trader inside of you, because, and I'll tell you something, after my second year of trading, I actually knew how to trade without realizing that I know how to trade. And this was because I was not being productive, I was not being profitable due to bad risk management, but I thought it was my strategy. I did not know it was my risk management. So you listening to me right now, you could actually be good at this, you could actually be there, but your risk management is what is making you not profitable. But instead of refining the risk management and getting more experience in your strategy, you are trying to find the next best strategy, which actually doesn't exist. So please take this seriously. Listen to this, watch this risk management, practice it. We'll do more videos on risk management and psychology in trading and all of that. But for now, I hope you had a good time. Have a beautiful day further. Wishing you all the best in your trading journey. Peace out.